Market Simplified, Your First Steps to Profitable Investing. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. Investing in the stock market can seem intimidating, especially if you've never done it. The world of stocks, bonds, and financial jargon can be overwhelming, but it doesn't have to be. This book aims to demystify the stock market, breaking down complex concepts into easy-to-understand explanations. Whether you're a beginner or looking to refine your investment knowledge, this guide will equip you with the essential tools and strategies to start investing confidently. The power of investing. Investing in the stock market is more than just a way to make money, it's a path to financial empowerment. By investing, you take control of your financial future, creating opportunities for growth and prosperity beyond your regular income. Historically, stocks have provided higher returns than other asset classes like bonds and real estate, making them an essential component of a well-rounded financial strategy. Overcoming common fears. Many people hesitate to invest because they fear losing money or don't know where to start. This book addresses these common fears head-on. We'll guide you through the process, from setting up a brokerage account to making your first trade. You'll learn to evaluate stocks, understand market trends, and build a diversified portfolio that aligns with your financial goals and risk tolerance. A practical approach. What sets this book apart is its practical approach. We believe anyone can become a successful investor with the proper knowledge and mindset. Each chapter is designed to be transformative, providing actionable insights and strategies you can apply immediately. You'll learn how to create a personalized investment plan, manage risks, and avoid common mistakes many new investors make. Join our vibrant community of seekers and learners by subscribing to the channel. Every subscription is a token of encouragement that fuels our ability to bring you more captivating and thought-provoking content. Subscribe, comment, and like. Become part of the movement shaping the future of learning and growth. In the comments, please let us know what type of books you would like to read. Your feedback helps us tailor our content to serve you better. Let's begin. Chapter 1. What exactly is the stock market? Have you ever wondered what the stock market is and how it works? This question is the starting point for many aspiring investors. Although the stock market can seem intimidating and complex, it operates on some straightforward principles. Let's break it down. The stock market is a marketplace where investors buy and sell publicly traded company shares. Think of it as a giant auction house where companies list their shares and investors place bids to buy them. The stock market facilitates these transactions, providing a platform for buyers and sellers to interact. Understanding stocks. A stock represents a share in the ownership of a company. When you purchase a stock, you buy a small piece of that company. As a shareholder, you have a claim on part of the company's assets and earnings. Stocks are equities because they signify an equity interest in the company. Companies issue stocks to raise money for various purposes, such as expanding operations, developing new products, or paying off debt. Companies can access a large pool of capital by selling shares to the public. In return, investors who buy these shares have the potential to earn returns through dividends and capital appreciation. The role of stock exchanges. Stocks are traded on stock exchanges, which are organized markets where securities are bought and sold. The most well-known stock exchanges include the New York Stock Exchange and the Nasdaq. These exchanges provide a regulated environment that ensures fair and transparent transactions. Each stock exchange has listing requirements that companies must meet to have their shares traded there. These requirements include financial benchmarks, corporate governance standards, and disclosure obligations. By meeting these standards, companies assure investors of their legitimacy and economic health. Several key players operate within the stock market. Investors, individuals or institutions that buy and sell stocks, or brokers. Intermediaries who facilitate the buying and selling of stocks for investors. They charge a fee or commission for their services. Market makers, firms or individuals that provide liquidity by buying and selling stocks from their accounts. Regulators, government agencies and organizations, like the Securities and Exchange Commission, are responsible for monitoring the market to safeguard investors and promote fair practices. How prices are determined. Stock prices are determined by supply and demand dynamics. The price goes up when more investors want to buy stock, rather than sell at supply. Conversely, the price decreases if more investors want to sell a stock than buy it. Various factors, including company performance, economic conditions, and investor sentiment, influence this continuous fluctuation in stock prices. Benefits of investing in the stock market. Capital appreciation. Over time, stocks can increase in value, providing significant returns. Dividend income. Some companies pay dividends, a portion of their profits distributed to shareholders. Liquidity. Stocks are highly liquid assets that can be quickly bought or sold. Or diversification. Stocks offer a way to diversify your investment portfolio, spreading risk across different companies and sectors. Challenges and risks. While the stock market offers numerous benefits, it also comes with risks. Stock prices can be volatile, and there's always the risk of losing your investment. Understanding these risks and developing strategies to manage them effectively is crucial. Now that you understand the stock market and its operation, the next logical question is, why should you invest in stocks? In the next chapter, we'll explore the compelling reasons for investing in the stock market and how it can help you achieve your financial goals. Stay tuned as we delve deeper into the world of stock investing and uncover the potential rewards it offers. Chapter 2. Why should you invest in stocks? Why should you consider investing in stocks over other types of investments? This is a fundamental question that many new investors grapple with. Understanding the unique advantages of stock investing can help you make informed decisions that align with your financial goals. Higher potential returns. Historically, stocks have consistently outperformed other investments, such as bonds and real estate. Although investing always carries some risk, the stock market has demonstrated an average yearly return of approximately 7 to 10% when accounting for inflation. This indicates that investing in stocks can substantially increase your wealth over the long run. Capital appreciation. One of the primary reasons people invest in stocks is the opportunity for capital appreciation. This means the value of your investments can increase over time. When you buy company shares, you're essentially buying a piece of that company's future. If the company grows and becomes more profitable, the value of your shares is likely to increase, providing you with capital gains. Dividend income. Many companies distribute a portion of their profits to shareholders through dividends. These regular payments can provide a steady income stream, which can be especially appealing for those looking to supplement their income in retirement. Dividend-paying stocks can also protect against inflation, as companies often increase dividends over time. Diversification. Stocks offer a way to diversify your investment portfolio. Diversification is a strategy that involves spreading your investments across different asset classes to reduce risk. By including stocks in your portfolio, you can balance the potential higher returns of equities with the stability of other investments, such as bonds or real estate. This helps mitigate the impact of poor performance in any single asset class. Liquidity. Stocks are highly liquid assets that can be quickly bought or sold in the market without significantly affecting price. This liquidity provides investors with flexibility and access to their money when needed. Unlike real estate or less liquid investments, stocks can be easily converted to cash, making them a convenient option for investors needing quick access to their funds. Ownership and influence. When you buy company shares, you become a part owner of that company. This ownership includes certain rights, such as voting on critical corporate decisions and receiving annual reports. While individual investors typically have limited influence, being a shareholder allows you to participate in the company's growth and success. The power of compound interest. One of the most powerful concepts in investing is compound interest. Compounding occurs when your investment earnings generate additional earnings. Over time, this compounding effect can lead to exponential growth in your investment portfolio. The earlier you start investing, the more time your money has to compound and grow, which is why starting early is so beneficial. Hedge against inflation. Inflation erodes money's purchasing power over time. Investing in stocks can help protect against inflation because companies often pass on increased costs to consumers through higher prices. As a result, companies' revenues and profits can rise with inflation, potentially leading to higher stock prices and dividends. Now that you understand the compelling reasons for investing in stocks, you might wonder how to start. What are the first steps to take if you want to begin your investment journey? The next chapter will guide you through the practical steps of starting stock investing, including setting up a brokerage account, defining your investment goals, and making your first trade. Join us as we turn theory into action and help you take those crucial first steps toward becoming a successful investor. Chapter 3: How to get started with stock investing. What are the first steps to take to start investing in stocks? Embarking on your investment journey can be both exciting and a bit daunting, but with the proper guidance, you can navigate this process smoothly and confidently. Setting up a brokerage account. The first step in stock investing is to open a brokerage account. A brokerage account is an investment account that allows you to buy and sell securities like stocks, bonds, and mutual funds. Here's how to get started. Research brokerage firms. Look for a reputable brokerage firm that offers low fees, a user-friendly platform, and good customer service. Some popular options include Charles Schwab, Fidelity, and E-Trade. Account types. Choose the type of brokerage account that suits your needs. Standard options include individual taxable accounts, retirement accounts like IRS, and custodial accounts for minors. Application process. Complete the online application, providing necessary information such as your Social Security number, employment details, and financial information. Complete the online application, providing the necessary information, such as your Social Security number, employment details, and financial information. 5. Fund your account. Once your account is set up, you must transfer funds from your bank account to your brokerage account. Most brokerages offer funding options, including bank transfers, wire transfers, and checks. Defining your investment goals. Before making any investments, it's essential to define your investment goals. Clear objectives will help you make informed decisions and stay focused on your long-term strategy. Consider the following questions. What are you investing for? Are you saving for retirement, a down payment on a house, or a child's education? What is your time horizon? How long do you plan to hold your investments? Short-term goals of less than 5 years may require a different strategy than long-term goals of 10 years or more. What is your risk tolerance? How comfortable are you with the potential for losing money in the short term? Your risk tolerance will influence the types of investments you choose. Creating an investment plan. An investment plan outlines your strategy for achieving your financial goals. It includes your target asset allocation, specific investments, and a timeline for reaching your objectives. Here's a simple framework to get started. Determine asset allocation. Decide how to divide your investments among asset classes, such as stocks, bonds, and cash. A common rule of thumb is subtracting your age from 100 to determine the percentage of your portfolio in stocks. Select investments. Choose stocks, ETFs, or mutual funds that align with your asset allocation and investment goals. Research each option carefully, considering factors like performance history, fees, and risk level. Regular contributions. Plan to make regular contributions to your investment account. Consistently adding funds, even in small amounts, can significantly boost your portfolio. Making your first trade. With your brokerage account funded and your investment plan in place, it's time to make your first trade. Here's a step-by-step guide. Research stocks. Use your brokerage's research tools to find stocks that meet your criteria. Look at the company's financials, performance history, and recent news. Place an order. Decide how many shares you want to buy and at what price. You can place a market order buying at the current market price or a limit order buying only if the stock reaches a specific price. Monitor your investments. After making your purchase, regularly review your portfolio to ensure it aligns with your goals. Stay informed about market trends and news related to your investments. Now that you know how to start stock investing, you might wonder how to evaluate the stocks you're considering. What makes a stock a good investment, and how can you tell if it's right for you? In the next chapter, we'll dive into the methods of evaluating stocks, including fundamental and technical analysis. Join us as we explore the tools and techniques to help you make informed and confident investment decisions. Chapter 4. How to evaluate stocks. How do you know if a stock is worth investing in? This question is crucial for any investor looking to build a successful portfolio. Evaluating stocks involves both an art and a science, requiring financial analysis and market insight. Fundamental analysis. Fundamental analysis involves evaluating a company's financial health and performance to determine its intrinsic value. This method focuses on the underlying factors influencing a stock's long-term performance. Here are the key components of fundamental analysis. Financial statements. Review the company's financial statements, including the balance sheet, income statement, and cash flow statement. These documents provide insights into the company's financial stability, profitability, and cash flow management. Earnings per share. EPS is a vital indicator of a company's profitability. It's calculated by dividing the company's net income by the outstanding shares. Higher EPS values generally indicate better performance. Price to earnings ratio. The ratio compares a company's stock price to its earnings per share. It helps investors determine if a stock is overvalued or undervalued compared to its earnings. A lower P/E ratio might indicate a more attractive investment, assuming the company's strong fundamentals. Dividend yield. If the company pays dividends, the dividend yield is an important metric. It's calculated by dividing the annual dividend payment by the stock price. A higher yield can be appealing to income-focused investors. Revenue growth. Analyze the company's revenue trends over time. Consistent revenue growth suggests a company is expanding its operations and market presence. Qualitative analysis. In addition to quantitative metrics, qualitative factors play a significant role in stock evaluation. These factors include management quality. Evaluating the skills and past performance of the leadership team is crucial. Capable and seasoned management is critical in propelling a company towards success. Competitive advantage. Identify the company's competitive edge or unique selling proposition. Companies with a solid competitive advantage are more likely to sustain long-term growth. Industry position. Consider the company's position within its industry. Market leaders or companies with significant market share often have more growth potential. Economic moat. An economic moat refers to a company's ability to maintain competitive advantages over its rivals, protecting its market share and profitability. Technical analysis. Technical analysis focuses on historical price movements and trading volume to predict future stock performance. Unlike fundamental analysis, which looks at the intrinsic value, technical analysis concerns market trends and investor behavior. Key concepts include price charts. Examine price charts to identify patterns and trends. Common patterns include head and shoulders, double tops, and ascending triangles. Moving averages. Smooth out price data to identify trends over time. The two most common types are the simple and exponential moving average. Relative Strength Index. RSI measures the speed and change of price movements. It helps determine if a stock is overbought or oversold, indicating potential buy or sell signals. Support and resistance levels. Support levels are prices where a stock tends to find buying interest, preventing it from falling further. Resistance levels are prices where selling interest is strong enough to stop the stock from rising further. Combining both approaches. While some investors prefer one method, combining fundamental and technical analysis can provide a more comprehensive evaluation. Fundamental analysis helps you understand the company's value, while technical analysis offers insights into market timing and investor sentiment. Now that you know how to evaluate stocks, you might wonder about the balance between risk and reward in your investments. How do you assess the risks involved, and what strategies can you use to manage them effectively? In the next chapter, we'll explore the role of risk and reward in investing, helping you develop a balanced approach to building your portfolio. Join us as we delve into the strategies for managing risk while maximizing your investment returns. Chapter 5. The role of risk and reward in investing. Understanding risk and reward is crucial to successful investing. Every investment carries some risk, and balancing that risk against potential rewards is critical to building a profitable portfolio. This chapter explores the dynamics of risk and reward and how you can manage them effectively. Understanding risk. Risk in investing refers to losing some or all of your investment. Various factors contribute to investment risk, including market volatility, economic conditions, and company performance. Here are the primary types of risks associated with stock investing. Market risk. This is the risk of losses due to factors that affect the overall market, such as economic recessions, political instability, or natural disasters. Market risk impacts all stocks, regardless of individual company performance. Company risk, also known as business risk, this pertains to the risk associated with the individual company you invest in. Factors like management decisions, competitive positioning, and product success play a role. Liquidity risk. This risk arises when a stock cannot be bought or sold quickly enough to prevent or minimize a loss. Stocks with low trading volumes are more susceptible to liquidity risk. Interest rate risk. Changes in interest rates can affect the performance of stocks, particularly those in sectors sensitive to borrowing costs, like real estate and utilities. Inflation risk. Inflation can erode the purchasing power of your investment returns. If your investments do not grow at a rate that outpaces inflation, you may experience a loss in real terms. Balancing risk and reward. The relationship between risk and reward is fundamental to investing. Generally, higher risk investments offer the potential for higher returns, while lower risk investments provide more stable but modest returns. Here's how you can balance risk and reward in your portfolio. Diversification. Spreading your investments across different asset classes, sectors, and geographic regions can reduce risk. Diversification helps mitigate the impact of poor performance in any single investment. Asset allocation. This involves dividing your portfolio among asset categories, such as stocks, bonds, and cash. The appropriate allocation depends on your risk tolerance, investment goals, and time horizon. Risk tolerance. Assess your risk tolerance by considering how much risk you're willing to take and your ability to endure potential losses. Your risk tolerance will guide your investment choices and strategy. Time horizon. The time you plan to hold your investments can influence your risk tolerance. Longer time horizons allow for greater risk-taking, as you have more time to recover from potential losses. Regular review and rebalancing. Periodically reviewing and rebalancing your portfolio ensures that your asset allocation aligns with your investment goals and risk tolerance. Rebalancing involves buying or selling assets to maintain your desired allocation. Risk management strategies. Stop-loss orders. A stop-loss order instructs you to sell a stock when it reaches a specific price, limiting potential losses. This strategy helps protect your investment from significant declines. Hedging. Hedging involves using financial instruments, such as options or futures, to offset potential investment losses. While hedging can reduce risk, it can also limit potential gains. Research and due diligence. Thoroughly researching and understanding your investments can help mitigate risk. Stay informed about the companies you invest in and the broader market conditions. Stay disciplined. Avoid making impulsive decisions based on short-term market movements. Stick to your investment plan and long-term goals, maintaining a disciplined approach. Understanding and managing risk is essential, but how do you build a portfolio that mitigates risk and capitalizes on opportunities? The next chapter will delve into the art of creating a diversified portfolio. We'll explore the principles of diversification, asset allocation, and how to balance your investments to achieve long-term success. Join us as we guide you through creating a resilient and profitable investment portfolio. Chapter 6: Building a Diversified Portfolio. What does it mean to have a diversified portfolio, and why is it important? Diversification is a fundamental strategy in investing that helps manage risk and enhance returns by spreading investments across various assets. In this chapter, we'll explore the principles of diversification and how to apply them to your portfolio. The importance of diversification. Diversification reduces the risk of your portfolio by limiting the impact of poor performance from any single investment. By holding various assets, you can cushion the blow of a downturn in any area. Here's why diversification matters. Risk reduction. Different asset classes and sectors respond differently to market conditions. Diversifying reduces the likelihood that all your investments will suffer simultaneously. Smoother returns. A diversified portfolio can provide more consistent returns, reduce volatility, and help you stay invested during market fluctuations. Capital preservation. By spreading risk, Diversification helps preserve your capital and protect your investment from significant losses. Principles of diversification. Asset classes. Include asset classes such as stocks, bonds, real estate, and cash. Each asset class behaves differently under various market conditions, balancing your portfolio. Sectors and industries. Within your stock investments, diversify across different sectors and industries. For example, technology, healthcare, finance, and consumer goods often react differently to economic changes. Geographic regions. Investing in companies from various countries and regions is an excellent idea to reduce risks associated with specific countries. Diversifying globally can shield you from economic downturns in one particular area. Investment styles. Include a mix of growth and value stocks and large cap, mid cap, and small cap stocks. Different investment styles perform differently under various market conditions. Determine your asset allocation. Based on your risk tolerance, investment goals, and time horizon, decide how to allocate your investments among different asset classes. A common approach is the age-based allocation rule. Subtract your age from 100 to determine the percentage of your portfolio to allocate to stocks. Select individual investments. Choose specific investments that fit within your asset allocation. For stocks, select companies across various sectors and regions. For bonds, consider different maturities and credit qualities. Use ETFs and mutual funds. Exchange-traded funds, ETFs, and mutual funds are excellent tools for diversification. They expose a broad range of assets, sectors, and regions with a single investment. Monitor and rebalance. Review your portfolio regularly to ensure it remains aligned with your asset allocation. Rebalance by selling overperforming assets and buying underperforming ones to maintain your desired allocation. Practical tips for diversification. Avoid overconcentration. Please don't put too much of your portfolio into any single investment, no matter how promising it seems. Consider correlations. Choose investments that are not highly correlated, meaning they don't move in the same direction under similar conditions. Stay disciplined. Stick to your diversification strategy, even when tempted to chase high returns from a single asset or sector. Now that you understand how to build a diversified portfolio, the next question is whether to invest for the short or long term. What are the benefits and drawbacks of each approach, and which one aligns with your financial goals? In the next chapter, we'll explore the differences between long-term and short-term investing, helping you decide which strategy suits you best. Join us as we delve into the pros and cons of each approach and how to balance them in your investment plan. Chapter 7. Long-term versus short-term investing. Should you invest for the short term or the long term? Understanding the differences between these two approaches is critical to developing an investment strategy that suits your financial goals. Both long-term and short-term investing have advantages and challenges, and the best approach depends on your objectives, risk tolerance, and time horizon. Long-term investing. Long-term investing involves holding investments for several years, often decades, to benefit from the growth potential of the markets. This strategy is built on the belief that, despite short-term volatility, the market will generally trend upward over time. Here are the key benefits and considerations. Compound growth. The power of compound interest is a significant advantage of long-term investing. Reinvesting dividends and capital gains can lead to exponential growth over time. Reduced transaction costs. Fewer trades mean lower transaction costs and fees, which can erode investment returns over time. Tax efficiency. Long-term investments benefit from lower capital gains tax rates compared to short-term trades. Emotional discipline. Long-term investing requires patience and discipline to withstand market volatility and avoid emotional decisions based on short-term market movements. Strategic benefits. Holding investments for the long term allows you to focus on fundamental growth rather than daily price fluctuations. Challenges of long-term investing. Patience required. Long-term investing demands patience and the ability to stay invested during market downturns. Market volatility. Long-term investors must be comfortable with market fluctuations and confident that the market will recover. Delayed gratification. The benefits of long-term investing may take years or even decades to materialize. Short-term investing. Short-term investing, often called trading, involves buying and selling investments over shorter periods, ranging from a few days to a few months. This strategy aims to capitalize on market fluctuations and achieve quick gains. Here are the key benefits and considerations. Quick profits. Short-term investing can generate quick profits by exploiting market volatility and price movements. Active management. This strategy allows investors to manage their portfolios and adjust based on market conditions actively. High transaction costs. Frequent trading can lead to significant transaction costs and fees, reducing overall returns. Tax implications. Short-term gains are taxed more than long-term gains, impacting net profits. Time-consuming. Successful short-term investing requires constant monitoring of the markets and staying updated with financial news and trends. Higher risk. The potential for quick gains comes with higher risk and the possibility of significant losses. Choosing the right approach. The choice between long-term and short-term investing depends on your financial goals, risk tolerance, and time horizon. Here are some factors to consider. Financial goals. Long-term investing might be more appropriate if you save for long-term objectives like retirement or a child's education. Short-term investing, or a more conservative approach, might be better for short-term goals, such as saving for a down payment on a house. Risk tolerance. Assess your comfort level with risk. Long-term investing is generally less risky due to the potential for market recovery over time. Short-term investing requires a higher risk tolerance and the ability to handle market volatility. Time horizon. Your investment time frame is crucial. The longer your time horizon, the more you can benefit from the compounding effect and ride out market fluctuations. Short-term investing suits those with a shorter time horizon and liquidity needs. Now that you understand long-term and short-term investing better, how do economic indicators influence the stock market? What role do GDP, unemployment rates, and inflation play in your investment decisions? In the next chapter, we'll explore the impact of economic indicators on the stock market and how you can use this information to make informed investment choices. Join us as we dive into financial data and its significance for investors. Chapter 8. The impact of economic indicators on the stock market. How do economic indicators affect the stock market? Economic indicators are crucial data that reflect the economy's overall health. Understanding these indicators can help you make informed investment decisions and anticipate market movements. Gross Domestic Product (GDP). GDP measures the total value of goods and services produced within a country over a specific period. It's a broad indicator of economic activity and growth. When GDP grows, it signals a healthy economy, which is generally positive for the stock market. Conversely, a declining GDP can indicate economic trouble and potentially lead to a bearish market. Positive impact. When GDP growth is strong, companies perform well, increasing stock prices. Investors gain confidence, and the market often experiences bullish trends. Negative impact. A shrinking GDP can result in lower corporate earnings and reduced investor confidence, causing stock prices to fall. Unemployment rate. The unemployment rate measures the percentage of the labor force that is unemployed and actively seeking employment. This indicator provides insight into the labor market's health and consumer spending power. Positive impact. A low unemployment rate suggests a strong job market, leading to higher consumer spending and increased corporate profits, boosting stock prices. Negative impact. High unemployment can reduce consumer spending and corporate earnings, lowering stock prices and potentially a bearish market. Inflation rate. Inflation measures the rate at which prices for goods and services rise over time. Moderate inflation is typically a sign of a growing economy, but high inflation can erode purchasing power and hurt corporate profits. Positive impact. Moderate inflation indicates economic growth, which can be positive for stocks, especially in consumer goods and technology. Negative impact. High inflation can increase company costs, reduce profit margins, and potentially lower stock prices. It can also prompt central banks to raise interest rates, negatively impacting the stock market. interest rates. Central banks set interest rates, which influence the cost of borrowing and the return on savings. They play a critical role in economic activity and the stock market. Positive impact. Lower interest rates make borrowing cheaper, encourage business expansion and consumer spending, and boost stock prices. They also make stocks more attractive than bonds and savings accounts. Negative impact. Higher interest rates increase borrowing costs, slowing business growth and reducing consumer spending. This can lead to lower stock prices as corporate earnings may decline. Consumer Confidence Index (CCI). The CCI measures how optimistic or pessimistic consumers are about the economy's future. High consumer confidence indicates that people are more likely to spend money, which can drive economic growth and stock market gains. Positive impact. High consumer confidence boosts spending, leading to higher corporate earnings and stock prices. Negative impact. Low consumer confidence can reduce spending, harm corporate profits, and potentially lead to declining stock prices. Producer Price Index (PPI) and Consumer Price Index (CPI). The PPI measures the average change in selling prices received by domestic producers for their output, while the CPI measures the average change in prices paid by consumers for goods and services. Positive impact. Stable PPI and CPI figures indicate controlled inflation, which benefits the economy and stock market. Negative impact. Sharp increases in PPI and CPI can signal rising inflation, leading to higher business costs and lower profit margins, negatively impacting stock prices. Balancing economic indicators in investment decisions. Successful investors consider a combination of economic indicators to gauge the market's direction and make informed decisions. Here are some tips on using these indicators. Stay informed. Regularly monitor vital economic reports and updates. Reliable sources include government publications, financial news websites, and economic research organizations. Analyze trends. Look at trends over time, rather than single data points. Consistent patterns in economic indicators can provide a clearer picture of financial health and market direction. Diversify investments. Diversify your portfolio to mitigate the impact of economic fluctuations. A well-diversified portfolio can help cushion against adverse economic changes. Adjust strategies. Be prepared to adjust your investment strategy based on economic conditions. For example, during periods of high inflation, you might focus on sectors that traditionally perform well under such conditions, like commodities and consumer staples. Now that you understand how economic indicators influence the stock market, it's important to be aware of the common mistakes new investors make and how to avoid them. What are the pitfalls that can derail your investment journey, and how can you steer clear of them? In the next chapter, we'll highlight these common mistakes and provide practical advice to help you build a successful investment strategy. Join us as we uncover the most frequent missteps and how to sidestep them for a more prosperous investing experience. Chapter 9. Common mistakes new investors make. What are the common pitfalls that new investors should avoid? Even the most experienced investors make mistakes, but learning from these errors can help you avoid costly missteps and build a successful investment strategy. This chapter highlights the most common mistakes new investors make and offers practical advice on how to avoid them. Emotional trading. One of the biggest mistakes new investors make is letting emotions drive their investment decisions. Fear and greed are powerful emotions that can lead to poor choices. Fear of losing money can cause investors to sell their stocks during market downturns, locking in losses instead of waiting for a potential recovery. Greed can lead to chasing after high-flying stocks or making impulsive decisions based on hype rather than sound analysis. How to avoid it. Develop a clear investment plan and stick to it, regardless of market fluctuations. Stay focused on your long-term goals and avoid making decisions based on short-term market movements. Lack of research. Investing without proper research is like going on a road trip without a map. Many new investors make the mistake of buying stocks based on tips from friends, family, or social media, without understanding the company or its prospects. How to avoid it. Take the time to research and understand any stock before you invest. Look at the company's financial health, competitive position, and growth potential. Utilize both fundamental and technical analysis to inform your decisions. Overtrading. Frequent stock buying and selling, known as overtrading, can erode investment returns due to transaction costs and taxes. Overtrading is often driven by the desire to capitalize on every market movement. How to avoid it? Adopt a long-term investment approach and resist the urge to constantly trade. Focus on the quality of your investments and give them time to grow. Only make changes to your portfolio when there is a compelling reason to do so. Ignoring diversification. Failing to diversify your portfolio is a common mistake that increases risk. Putting all your money into a single stock or sector can lead to significant losses if that investment performs poorly. How to avoid it? Diversify your investments across different asset classes, sectors, and geographic regions. This reduces the impact of any single investment's poor performance on your overall portfolio. Timing the market. Many new investors try to time the market, buying low and selling high. However, even professional investors find it challenging to consistently predict market movements. How to avoid it? Instead of trying to time the market, focus on time in the market. Invest regularly and stay invested for the long term. Use dollar-cost averaging to mitigate the impact of market volatility by spreading your investments over time. Neglecting to rebalance. As markets fluctuate, your portfolio's asset allocation can drift away from your original plan. Neglecting to rebalance can lead to a portfolio that no longer aligns with your risk tolerance and investment goals. How to avoid it? Review and rebalance your portfolio regularly to maintain your desired asset allocation. This involves selling assets that have become overweight and buying those that are underweight. Ignoring fees and costs. It's important to remember that investment fees and costs can really eat into your returns in the long run. Don't forget to focus on minimizing fees to maximize your net returns. How to avoid it? Be aware of the fees associated with your investments, including brokerage fees, management fees, and expense ratios. Choose low-cost investment options, such as index funds and ETFs, to maximize your returns. Following the crowd. Herd mentality can lead investors to follow the crowd and make decisions based on popular trends rather than sound analysis. This can result in buying overvalued stocks or selling undervalued ones. How to avoid it? Make investment decisions based on your research and analysis, not on what everyone else is doing. Stay disciplined and adhere to your investment strategy. Now that you know how to avoid common mistakes, it's crucial to stay informed and continuously educate yourself as an investor. How can you keep up with the ever-changing market and ensure that your investment strategy remains sound? In the next chapter, we'll discuss the importance of staying informed and how to leverage ongoing education to enhance your investment success. Join us as we explore the resources and strategies that will keep you ahead in the dynamic world of investing. Chapter 10. The importance of staying informed. How can staying informed improve your investment success? The stock market is dynamic, and staying updated with the latest news and trends is essential for making sound investment decisions. Continuous learning and staying informed are crucial to navigating the ever-changing landscape of investing. Why staying informed matters. Staying informed helps you make timely and well-informed decisions, allowing you to respond to market changes, economic shifts, and company-specific events. It also helps you identify new investment opportunities and avoid potential pitfalls. Reliable sources of information. To stay informed, you need to rely on credible sources of financial news and data. Here are some reliable sources. Financial news websites. Websites like Bloomberg, CNBC, and Reuters provide up-to-date news and analysis on the financial markets. These platforms offer insights into market trends, economic data, and corporate developments. Investment newsletters. Subscribing to investment newsletters from reputable analysts can provide valuable insights and recommendations. These newsletters often include market analysis, stock picks, and economic forecasts. Company reports. Reading quarterly and annual reports of the companies you invest in helps you stay informed about their performance and strategic direction. These reports provide detailed financial information and management discussions. Economic reports. Observing economic reports from government agencies and financial institutions can help you understand the broader economic environment. Key reports include GDP, unemployment rates, and inflation data. Investment books and journals. Books and academic journals on investing provide in-depth knowledge and strategies. Authors like Benjamin Graham, Peter Lynch, and Warren Buffett offer timeless wisdom on investment principles. Staying updated with market trends. Understanding market trends is crucial for making informed investment decisions. Here are some ways to stay updated. Market indices. Monitor major market indices like the S&P 500, Dow Jones Industrial Average, and NASDAQ. These indices provide a snapshot of overall market performance and trends. Sector analysis. Analyzing different sectors can help you identify which industries are performing well and which are struggling. This information can guide your sector allocation decisions. Technical analysis. Using technical analysis tools, such as moving averages and relative strength index RSI, can help you identify trends and potential entry or exit points for your investments. Continuous learning and education. Investing is a continuous learning process. The more you educate yourself, the better equipped you'll be to make informed decisions. Here are some ways to enhance your investment education. Online courses and webinars. A variety of financial institutions and universities provide online courses and webinars focusing on investment education. These resources delve into a broad spectrum of subjects, ranging from fundamental investing concepts to more complex strategies. Investment forums and communities. Participating in investment forums and online communities can provide valuable insights and allow you to share knowledge with other investors. Platforms like Seeking Alpha and Reddit's R Investing are popular among investors. Books and publications. Regularly reading investment books and publications keeps you updated on new strategies and market developments. Consider reading classic investment books like The Intelligent Investor by Benjamin Graham and One Up on Wall Street by Peter Lynch. Staying disciplined. Staying informed is essential, but it's equally crucial to stay disciplined. Here are some tips to maintain discipline. Stick to your plan. Adhere to your investment plan and avoid making impulsive decisions based on short-term market movements. Avoid overreacting. Market volatility is normal. Avoid overreacting to short-term news and focus on long-term trends and fundamentals. Review and adjust. Regularly review your investment portfolio and make adjustments as needed to stay aligned with your goals and risk tolerance. Now that you understand the importance of staying informed, it's time to put this knowledge into action. How can you take your first steps towards profitable investing? In the next chapter, we'll recap the key points discussed throughout this book and provide a practical guide to making your first investments. Join us as we empower you to take confident steps towards achieving your financial goals and building a successful investment portfolio. Chapter 11. Your first steps to profitable investing. What are the next steps after you've learned the basics of stock investing? Putting your knowledge into action is the final step to becoming a successful investor. This chapter will guide you through the practical aspects of making your first investments, ensuring you start on the right foot. Recap of key points. Before diving into the specifics of your first investments, let's recap some key points we've covered. The stock market is a marketplace where investors buy and sell shares of publicly traded companies. Benefits of investing in stocks. Stocks offer potential for higher returns, capital appreciation, dividend income, and portfolio diversification. Getting started. Set up a brokerage account, define your investment goals, and create an investment plan. Evaluating stocks. Use fundamental and technical analysis to assess the value and potential of stocks. Balancing risk and reward. Understand and manage the risks associated with investing while aiming for rewards. Building a diversified portfolio. Diversify across asset classes, sectors, and regions to reduce risk. Long-term versus short-term investing. Choose an investment strategy that aligns with your financial goals and risk tolerance. Economic indicators. Use economic data to inform your investment decisions. Avoiding common mistakes. Stay disciplined, avoid emotional trading, and do your research. Staying informed. Continuously educate yourself and stay updated on market trends and news. Creating a simple investment plan. Now let's turn theory into practice by creating a simple investment plan. This plan will help you stay focused and disciplined as you begin your investment journey. Set clear goals. Define what you want to achieve with your investments. Are you saving for retirement, a major purchase, or building wealth? Setting specific, measurable, achievable, relevant, and time-bound SMART goals will guide your investment decisions. Determine your risk tolerance. Evaluate your risk tolerance to determine the best asset allocation and investment decisions for you. Take into account your age, financial status, and investment timeline. Choose your asset allocation. Based on your risk tolerance, decide how to divide your portfolio among different asset classes. A common approach is to allocate a higher percentage to stocks when you're younger and gradually shift to bonds as you approach retirement. Select your investments. Choose a mix of individual stocks, ETFs, and mutual funds that align with your asset allocation and goals. Focus on diversification to spread risk across different sectors and regions. Set up automatic contributions. Consistently adding funds to your investment account can significantly boost your portfolio over time. Set up automatic contributions to ensure you regularly invest a portion of your income. Making your first investments. With your plan in place, it's time to make your first investments. Follow these steps to get started. Fund your brokerage account. Transfer the initial amount you've decided to invest from your bank account to your brokerage account. Research stocks. Use the tools and resources provided by your brokerage to research potential investments. Look at the company's financials, performance history, and market trends. Place your first trade. Decide on the number of shares you want to buy and the type of order to place, market order or limit order. Enter the trade details in your brokerage platform and execute the trade. Monitor your investments. Monitor your portfolio's performance and make adjustments as needed. Stay informed about market trends and company news that could impact your investments. Tips for new investors. Start small. Begin with a small investment to get comfortable with the process. As you gain experience, you can gradually increase your investment amounts. Stay disciplined. Stick to your investment plan and avoid making impulsive decisions based on short-term market movements. Be patient. Investing is a long-term game. Give your investments time to grow and don't panic during market downturns. Learn continuously. Make sure to continuously expand your knowledge about investing. Participate in webinars, explore books, and stay informed about the latest market news. Congratulations on taking the first steps towards investing in the stock market. Your journey to financial freedom is just beginning. But how do you stay on course and ensure long-term success? In the final chapter, we'll discuss the keys to maintaining a successful investment strategy over the long haul. Join us as we explore how to stay disciplined, manage your portfolio, and achieve your financial goals through sustained, strategic investing. Chapter 12. Maintaining long-term investment success. What are the keys to maintaining a successful investment strategy over the long haul? Achieving long-term success in investing requires discipline, continuous learning, and strategic management of your portfolio. In this final chapter, we'll discuss how to stay on course and ensure that your investments continue to grow and support your financial goals. Staying disciplined. Stick to your plan. Follow the investment plan you created, and avoid making impulsive decisions based on short-term market movements or emotional reactions. Regular contributions. Consistently add to your investment portfolio, regardless of market conditions. Regular contributions help take advantage of dollar-cost averaging, reducing the impact of market volatility. Avoid timing the market. Trying to time the market by predicting highs and lows is challenging and often leads to poor outcomes. Focus on long-term growth rather than short-term gains. Regular portfolio review and rebalancing. Regularly reviewing and rebalancing your portfolio ensures that it remains aligned with your investment goals and risk tolerance. Here's how to do it. Periodic review. Set a schedule to review your portfolio, such as quarterly or annually. Assess the performance of your investments and ensure they align with your financial goals. Rebalance your portfolio. Over time, some investments may outperform others, causing your asset allocation to drift. Rebalance by selling overweight assets and buying underweight ones to maintain your desired allocation. Adjust for life changes. Major life events, such as marriage, having children, or retirement, may require adjustments to your investment strategy. Ensure your portfolio reflects your current financial situation and goals. Staying informed and adapting. The investment world is always evolving. Staying updated and adjusting to new information is crucial for achieving long-term success. Continuous learning. Keep educating yourself about investing. Read books, attend webinars, and follow financial news to stay updated on market trends and investment strategies. Monitor economic indicators. Keep an eye on economic data and trends that could impact your investments. Understanding how these indicators affect the market can help you make informed decisions. Stay flexible. Be open to adjusting your strategy based on new information and market conditions. Flexibility allows you to capitalize on new opportunities and mitigate risks. Tax-efficient investing. Maximizing your after-tax returns is an essential aspect of long-term investment success. Here are some tax-efficient strategies. Utilize tax-advantaged accounts. Take advantage of tax-advantaged accounts like IRAs and 401ks. These accounts offer tax benefits that can help your investments grow more efficiently. Consider tax implications. Be mindful of the tax implications of your investment decisions. Long-term capital gains are taxed at lower rates than short-term gains, so consider holding investments for longer periods. Harvest tax losses. Use tax loss harvesting to offset capital gains. Selling investments that have lost value can help reduce your tax liability. Managing emotions. Emotions can significantly impact investment decisions. Here's how to manage them. Stay calm during volatility. Market fluctuations are normal. Avoid making hasty decisions based on short-term volatility. Keep a long-term perspective. Avoid herd mentality. Do your own research before following the crowd. Make investment decisions based on sound analysis and your financial goals. Focus on your goals. Keep your financial goals in mind and stay focused on your investment plan. This can help you stay disciplined and avoid emotional reactions. Seeking professional advice. A financial advisor can provide personalized guidance and help you create and maintain a successful investment strategy. Investment clubs. Joining an investment club can provide valuable insights and support from fellow investors. Robo-advisors. Consider using a robo-advisor for automated, algorithm-driven financial planning services. These platforms can help you manage your portfolio efficiently and cost-effectively. Your path to financial freedom. Congratulations on taking the journey through this book and arming yourself with the knowledge needed to start investing in the stock market. Remember, the key to long-term investment success is a combination of discipline, continuous learning, and strategic management of your portfolio. Your path to financial freedom begins with the first step, and every subsequent step will bring you closer to your goals. Stay focused, stay informed, and, most importantly, enjoy the journey. The stock market is a powerful tool that, when used wisely, can help you achieve your financial dreams. Thank you for listening. Elevate your learning journey with our channel by subscribing today. Each video we create is designed to challenge, inspire, and enlighten. By subscribing, you ensure you're up to date with the latest content and support our quest to make learning accessible and engaging. Your feedback helps us tailor our content to better serve you. Join the conversation below, and let's learn and grow together. Let's explore the limits of what we can achieve together. Be well and thrive.